All right, let's dive into the latest earnings call from ABM Industries. Now, this was a really fascinating quarter because it sent some seriously mixed signals to the market, and we're going to sort through the noise to figure out what's actually going on. So, what was the market's first reaction? Well, it wasn't pretty. The morning the numbers came out, the stock dropped over 5% in pre-market trading. So yeah, that initial gut reaction was definitely negative. And here's exactly why everyone was so confused. It was a classic good news, bad news story. On one hand, revenue came in higher than expected. That's a beat. But on the other hand, they missed on earnings per share, which, as you know, is the bottom line that everybody watches. A split decision like this always leaves investors scratching their heads. That's the big question we're going to tackle here. Was this a good quarter that just looked bad on the surface? Or are there some deeper problems brewing? Let's dig in and find out. Okay, so first up, let's unpack this divergence. It really is a classic tale of two tapes, where the strong results on the top line were kind of masking some of the weakness happening underneath. Just look at these numbers. The contrast is pretty stark. Revenue at $2.22 billion, a nice beat. And that free cash flow, wow, up 134% from last year, which is just incredible. But, and it's a big but, that adjusted EPS miss was significant, 82 cents when the street was looking for 95. Then, to pour a little salt on the wound, management took their full-year forecast down to the low end of the range. So the story is, growth is there, cash is flowing, but profitability and the outlook just took a hit. So that brings us to the big mystery of the quarter, the margins. Why did they miss on earnings, and where did all that profit go? Well, it turns out the answer lies in some very intentional, very strategic decisions they made. And we don't even have to guess, because the CEO, Scott Salmers, he basically spelled it out on the call. The company made a choice to get aggressive on pricing in certain markets to protect their turf for the long term. This wasn't an accident. It was a calculated move, sacrificing some profit today to secure their position for tomorrow. And this choice really played out through two totally different strategies. In their main business and industry segment, the playbook was all about defense, but in their fast-growing manufacturing and distribution segment, they decided to go on offense. Let's break down that defensive play. In some of the weaker office markets, like on the West Coast, clients are feeling the pressure. So instead of waiting and risking losing them to a competitor, ABM went to their big clients proactively. They renegotiated terms, tweaked some price increases, and in return, locked them into new 4- and 5-year contracts. The goal wasn't to squeeze every penny out of them right now. It was to make sure they stayed a customer for years to come. Now, let's talk about the opportunistic push. In these sectors that are absolutely on fire, think semiconductors, e-commerce, all that stuff coming back onshore. The goal was a land grab. Management was very open about this. They bid aggressively just to get a foot in the door. They even gave an example where they took on a new client in the semiconductor space at a profit margin that was about 1% lower than what they'd normally accept. Again, it's a trade-off. Take a small hit on margin today to grab a piece of some major long-term growth. Okay, so management knew these pricing moves would put a dent in their margins. So what was their counterplay? That brings us to their plan to get those profits back on track. They've launched a big company-wide restructuring program. And let's be clear, this isn't just about cutting costs randomly. It's a strategic move to realign their whole cost structure so it can support those pricing strategies and fund their biggest growth opportunities. And they've put some hard numbers on it. The target is to generate at least $35 million in annual savings. Now, it's going to cost them about $10 million in charges in the fourth quarter to get this thing off the ground, but they expect to be seeing the full benefit of those savings by the start of fiscal 2026. This is their direct answer to the margin question. So, this restructuring, along with a few other things, is why management sounds so confident they're going to have a huge finish to the year. So, let's look at the actual case for a big Q4 rebound. First, just take a look at the scale of this expected jump. To hit even the low end of their yearly guidance, they have to go from 82 cents in earnings last quarter to an implied $1.19 in Q4. I mean, that is a massive leap. So how in the world are they planning to get there? Well, the number one driver by a long shot is their technical solutions business, also known as ATS. This part of the company has a history of putting up monster numbers in the fourth quarter, and it looks like they're betting on it to deliver again. And if you look inside that ATS segment, the real powerhouse is their microgrids and power division. That now makes up nearly 60% of the business.
This is a super high-demand area right now, and it just so happens that it always hits its peak right at the end of their fiscal year.
So really, the Q4 rebound story rests on four key things. One, that powerful seasonal surge from ATS, where their margins typically jump up to 11 to 13%. Two, they'll start seeing the first benefits from that restructuring plan, maybe 20% of the savings. Three, they have some favorable price increases scheduled to kick in. And four, management made it clear that the margin pressure in Q3 was kind of a one-off event, with a bunch of negotiations hitting at once, and they don't expect a repeat performance.
All right, we've gone through the numbers, we've unpacked the strategy. Now it's time for our final section, the next call. We're going to put it all together into our verdict on the stock. So after digging through the entire earnings tape, the question for any investor is simple. What's the call on ABM Industries from here? Our rating is outperform. We think the market overreacted to the short-term margin hit, which was self-inflicted, by the way, and is seriously underappreciating how agile this company is and the smart strategic thinking behind these moves. And this rating leads us to a specific trade idea. Go long on ABM Industries and pair that with a short position in a basket of non-prime office REITs, especially the ones with buildings in those weaker markets management talked about.
Here's the thinking. ABM's margin pain is a direct signal that things are getting pretty rough in those secondary office markets. But here's the key. ABM has options. They have levers they can pull, like the restructuring plan and their diversification into fast-growing areas. The landlords who actually own those struggling office buildings, they don't have that flexibility. They can't just restructure their way out of a half-empty building. So, this trade is a bet on ABM's ability to adapt and bounce back, while also betting against the underlying weak assets that are facing some major long-term problems. You're long the adaptable company and short the challenged asset.
And just a final reminder, this is not financial advice.